Tonight, we are going to explore a system that is often overlooked, yet quietly shapes every part of how credit quietly shapes entire economies. Every day, something moves through the world that most people never see. It flows between individuals. It flows between businesses. It flows between nations. This thing is not a physical object. It cannot be held in the hand. Yet it determines what gets built, what gets bought, and what becomes possible. When someone acquires a home, this invisible force is present. When a business expands its operations, this force is there. When governments fund infrastructure projects that span years or decades, this same force enables the work to begin. The system operates continuously. It functions during daylight hours and through the night. It works on weekdays and weekends. There is no pause button. There is no central location where it resides. Most people participate in this system without recognizing their participation. They make decisions that seem personal or isolated. They believe these decisions affect only themselves. But each decision sends ripples through a vast network of connections. Consider the simple act of making a purchase. On the surface, it appears to be a straightforward exchange. One person wants something. Another person provides it. But beneath this surface, there exists a deeper architecture. This architecture is built on promises. It is constructed from agreements made between parties separated by time. Someone agrees to provide value now. Someone else agrees to provide value later. The gap between now and later is where this system lives. The gap creates possibility. It allows things to happen that could not otherwise occur. It permits growth where growth would be impossible. It enables movement where movement would be frozen. Without this system, economies would function differently. Construction projects would wait for full payment before beginning. Businesses would need complete funding before opening their doors. Individuals would need total savings before making significant acquisitions. The waiting would slow everything down. Opportunities would pass before anyone could act on them. Ideas would remain unrealized for years or generations. The pace of change would become glacial. But this system removes much of the waiting. It collapses time in a particular way. It brings future capacity into the present moment. It allows tomorrow's value to be accessed today. This time collapse is neither magical nor mysterious. It follows specific rules. It operates according to principles that have developed over centuries. These principles govern who can participate, under what conditions, and with what consequences. The system touches nearly everyone. Young people entering adulthood encounter it when pursuing education. Families engage with it when seeking shelter. Entrepreneurs interact with it when launching ventures. Even those who try to avoid it often find themselves affected by its presence. It shapes what is affordable and what is not. It influences which opportunities appear within reach. It affects how people plan for the future. It alters the relationship between present circumstances and future possibilities. The system also creates obligations. When someone accesses future value today, they accept a responsibility. They agree to fulfill their part of the arrangement. They commit to a particular path forward. These obligations link people across time. Today's decisions create tomorrow's requirements. Tomorrow's requirements shape next week's choices. Next week's choices influence next month's options. The chain extends forward, sometimes for years, sometimes for decades. The links in this chain are not visible to the naked eye. They exist as records in ledgers. They persist as agreements in contracts. They live as expectations in minds. But their invisibility does not make them weak. The opposite is true. These invisible links can be stronger than physical chains. They bind people to commitments, even when those people would prefer to be unbound. The system has memory. It remembers who kept their promises and who did not. It tracks patterns of reliability. It records histories of behavior. This memory influences the present. Those with histories of kept promises find doors opening more easily. Those with histories of broken promises find doors closing more firmly. The past does not disappear. It echoes forward. Everyone who participates in the system contributes to its memory. Each fulfilled obligation adds to one kind of record. Each missed obligation adds to another kind of record. The system learns from every interaction. Over time, these records accumulate. They form patterns. The patterns reveal tendencies. The tendencies predict probabilities. The system uses these probabilities to make decisions. It determines who receives access and who does not. It calculates how much access to grant. It establishes the terms under which access is provided. These calculations happen constantly. They occur millions of times each day across the world. Most people never witness the calculations. They only see the results. The results arrive as approvals or denials. They appear as numbers on documents. They manifest as possibilities that open or close. Behind each result lies a complex process. Information flows through channels. Data points are compared against thresholds. Algorithms apply formulas. Humans make judgments. The process aims to solve a fundamental problem. The problem is uncertainty. When someone promises to provide value in the future, will they actually do so? The question matters deeply to the system. If promises were always kept, the system would operate one way. If promises were never kept, the system could not exist at all. Reality falls between these extremes. Some promises are kept. Some promises are broken. The system must navigate this reality. It must find ways to say yes often enough to remain useful. It must find ways to say no often enough to remain stable. The balance requires constant adjustment. Different parts of the system handle the balance differently. Some parts are more cautious. Some parts are more adventurous. Some parts change their approach depending on conditions. These conditions vary. Sometimes the general environment feels stable and predictable. Other times it feels unstable and uncertain. The system's behavior shifts in response. When stability prevails, the system tends to expand. Access becomes easier to obtain. Terms become more generous. More people can participate. When uncertainty grows, the system tends to contract. Access becomes harder to secure. Terms become stricter. Fewer people qualify for participation. This expansion and contraction affects the broader economy. When the system expands, economic activity tends to increase. When the system contracts, economic activity tends to slow. The relationship works in both directions. The system responds to economic conditions, but economic conditions also respond to the system. They influence each other in an ongoing dance. This mutual influence creates patterns that repeat over time. Periods of expansion follow periods of contraction. Periods of contraction follow periods of expansion. The cycle continues. Understanding the system means understanding these cycles. It means recognizing how expansion sows the seeds of contraction. It means seeing how contraction creates conditions for expansion. But understanding also requires stepping back further. It requires examining what this system actually is at its core. It requires defining the thing that flows through all these channels. It requires naming the force that shapes so much economic activity. The system described in the previous section operates through something called credit. Credit is the ability to access resources or value in the present based on a promise to return equivalent or greater value in the future. At its essence, credit is trust formalized into an arrangement. One party trusts that another party will fulfill a future obligation. This trust becomes the foundation for current action. The word itself reveals the concept. Credit comes from the Latin word meaning to believe or to trust. The linguistic root points directly to the core principle. Someone believes in someone else's future capacity to deliver. This belief makes possible what would otherwise be impossible. It allows separation between the moment of receiving and the moment of giving. It creates a bridge across time. Without credit, all exchanges would need to be simultaneous. Both parties would need to deliver their parts of the bargain at exactly the same moment. This simultaneity would severely limit economic activity. Consider a farmer planting crops. The seeds go into the ground in spring. The harvest comes in autumn. Between planting and harvesting, the farmer needs to eat, needs shelter, needs tools. But the crops that will pay for these things do not yet exist. Credit solves this problem. The farmer obtains seeds, food, tools today. The farmer promises to repay after the harvest. Someone else believes in this promise. The transaction occurs. This simple example reveals credit's fundamental purpose. Credit exists to solve timing mismatches between needs and resources. Needs and resources rarely align perfectly in time. Someone needs something now, but will have the means to pay for it later. Someone else has something now, but does not need it immediately. Credit connects these misaligned circumstances. The connection benefits both parties. The person with current needs gains access to what they require. The person with current excess finds productive use for their surplus. But credit involves more than just delayed payment. It also involves compensation for the delay. When someone waits to receive value, they forego other opportunities. They could have used their resources differently. They could have consumed them, invested them elsewhere, or simply held them as security. Credit arrangements typically include compensation for this waiting. The party receiving resources now agrees to return more than they receive. The additional amount reflects several factors. One factor is the pure time value of waiting. Having something today is generally more useful than having that same thing tomorrow. The difference in usefulness has value. Another factor is uncertainty. The future always contains uncertainty. The promise to pay later might not be fulfilled. Compensation for bearing this uncertainty becomes part of the arrangement. A third factor is opportunity cost. Resources extended, as credit cannot be used for other purposes during the waiting period. The foregone alternatives have value. These factors combine to determine how much extra value must be returned. The additional amount goes by various names depending on the context. In many situations, it is called interest. Interest represents the cost of credit. It measures what must be paid beyond the original value received. It compensates the provider for time, risk, and opportunity. The specific amount of interest varies widely. It depends on how long the credit extends. It depends on how certain repayment appears. It depends on what alternatives exist. It depends on broader economic conditions. When repayment seems highly certain, interest tends to be lower. When repayment seems uncertain, interest tends to be higher. When credit extends over longer periods, interest accumulates to larger amounts. When credit extends over shorter periods, interest remains smaller. These variations create a landscape of different credit arrangements. Some credit is short-term, lasting days or weeks. Some credit is long-term, lasting years or decades. Some credit carries high costs. Some credit carries low costs. The landscape reflects countless individual assessments of trust and risk. Each credit arrangement emerges from a specific evaluation. Will this particular borrower repay? Under these particular terms, given these particular conditions. Credit exists because people and organizations face these timing mismatches constantly. Businesses need equipment before they have revenue to purchase it. Governments need infrastructure before they have collected the taxes to fund it. Individuals need education before they have earned the income that education will generate. In each case, credit allows the future to fund the present. It permits investment before return. It enables action before accumulation. This capacity transforms economic possibilities. It accelerates growth. It enables specialization. It supports innovation. Without credit, growth would be constrained by existing savings. Only those activities that could be funded entirely from accumulated resources would occur. New ventures would wait years or generations to begin. With credit, growth can outpace savings. Multiple projects can proceed simultaneously. Resources can be allocated based on future potential rather than only past accumulation. Credit also enables sharing of resources across society. Those who have accumulated surplus can make it available to those who have not yet accumulated. The transfer occurs voluntarily because both parties expect to benefit. The person providing credit expects to receive back more than they provided. The person receiving credit expects that the resources will enable them to generate enough value to repay the amount plus the additional compensation and still come out ahead. When both expectations prove correct, credit creates value for everyone involved. The provider gains returns. The receiver gains opportunities. Society gains productivity. When expectations prove incorrect, problems emerge. If the receiver cannot generate sufficient value to repay, they face difficulties. If providers extend credit that cannot be repaid, they face losses. Managing these expectations and outcomes requires information. Providers need to assess who is likely to repay and who is not. Receivers need to evaluate whether credit will genuinely help them or might burden them. This need for information creates entire industries devoted to evaluation and measurement. Organizations develop methods to predict repayment likelihood. They collect data about past behavior. They analyze patterns. They generate scores and ratings. These evaluation systems become part of the credit infrastructure. They help the system function more efficiently. They reduce uncertainty somewhat. They guide decision-making. But they do not eliminate uncertainty entirely. The future remains unknowable. Predictions sometimes prove wrong. Circumstances change in unexpected ways. Credit must operate despite this persistent uncertainty. It must function knowing that some promises will not be kept. It must build mechanisms to handle both success and failure. The mechanisms include legal frameworks. These frameworks establish what happens when obligations are not met. They provide procedures for resolution. They define rights and responsibilities. The mechanisms also include diversification. Credit providers spread their activities across many different arrangements. If some fail, others might succeed. The portfolio approach manages risk. The mechanisms further include reserves and cushions. Providers set aside resources to absorb losses. They maintain buffers against unexpected problems. These safety margins protect stability. All these mechanisms exist because credit is fundamentally about future promises. And future promises always carry uncertainty. The system acknowledges this uncertainty rather than denying it. The acknowledgement shapes how credit operates. Credit, then, is a tool for managing time mismatches in resource availability. It is a method for converting future capacity into present capability. It is an arrangement built on trust, formalized through agreement, and sustained through expectation of mutual benefit. This tool pervades modern economies. It flows through every sector. It touches nearly every transaction of significance. Its presence shapes outcomes often invisibly, but always powerfully. Understanding credit means understanding this fundamental mechanism. It means recognizing how promises about the future create possibilities in the present. It means seeing the bridge that spans from now to later. But understanding also requires knowing where credit comes from. How does it originate? Who creates it? Through what processes does it enter the economy? These questions lead to the next layer of explanation. Credit enters the economy through multiple channels. Each channel involves different participants following different processes, but all channels share certain common elements. The most fundamental form of credit creation occurs between individuals. One person lends to another directly. A friend extends credit to a friend. A family member extends credit to a family member. This direct credit requires only two parties and an agreement between them. The agreement might be formal with written terms. It might be informal with only verbal understanding. Either way, credit comes into existence when one party commits resources and the other party commits to repayment. The scale of such direct credit is limited. It depends on how much surplus the lender possesses. It depends on personal relationships and trust. It generally remains small relative to larger economic flows. But direct credit established important principles that larger systems would later follow. It demonstrated that credit could work. It showed that promises could be kept. It revealed both benefits and risks. As economies grew more complex, specialized institutions emerged to provide credit on a larger scale. These institutions could pool resources from many sources. They could evaluate creditworthiness more systematically. They could manage portfolios of many different credit arrangements. Banks became the primary institutions for credit creation in most modern economies. Banks perform a unique function that distinguishes them from other financial entities. When a bank makes a loan, something interesting occurs. The bank does not typically hand over physical currency that was sitting in its vault. Instead, the bank creates a deposit in the borrower's account. This deposit represents credit. It is money that the borrower can spend. But it came into existence through the act of lending. The process might seem strange at first. How can banks create money simply by making loans? The answer lies in the nature of modern money itself. Most money today exists as electronic records rather than physical objects. When people talk about having money in the bank, they mean the bank's records show a certain balance in their account. The money is information, not stuff. Banks can alter these records. When a bank approves a loan, it increases the balance in one account. That increased balance is new money. It did not exist before the loan. The loan brought it into being. Of course, this process operates within constraints. Banks cannot create unlimited credit. Various rules and practical limitations shape their activities. One constraint is regulatory. Authorities establish requirements for how banks must operate. These requirements include maintaining certain ratios between different types of assets. They include holding reserves against potential losses. They include following specific procedures for evaluating credit applications. Another constraint is practical. When a bank creates a loan and the borrower spends the money, the funds typically leave the bank. The bank must be able to honor these outflows. If too much money flows out without corresponding inflows, the bank faces problems. A third constraint is competitive. Banks operate in markets where they compete with other banks. If one bank offers credit on terms that prove unsustainable, it will eventually face consequences. The competitive environment provides feedback that influences behavior. These constraints mean banks must balance expansion of credit against stability and sustainability. They must create enough credit to be profitable and useful. They must avoid creating so much credit that they undermine their own viability. The balancing act involves constant judgment. Each loan application presents a decision. Will this borrower repay? Does extending this credit serve the bank's interests? Does it serve the economy's interests? Banks gather information to inform these judgments. They examine income streams. They review employment history. They check records of past credit usage. They assess the value of any collateral offered. This information flows into evaluation systems. Sometimes humans review it directly and make decisions based on experience and judgment. Sometimes algorithms process it and generate recommendations or automatic decisions. Often both humans and algorithms play roles. The evaluation aims to predict the likelihood of repayment. High likelihood leads to approval. Low likelihood leads to denial. Moderate likelihood might lead to approval with specific conditions or higher interest rates. Through millions of these individual decisions, banks collectively determine how much credit enters the economy. Their aggregate lending expands or contracts the total supply of credit. But banks are not the only creators of credit. Other institutions also participate. Governments create credit when they issue bonds. A bond is a formalized promise to repay borrowed funds plus interest over a specified time period. Investors purchase these bonds, providing resources to governments now. Governments commit to repayment later. Government credit works differently from bank credit in important ways. Governments typically do not create money through their borrowing. Instead, they borrow existing money from others. The credit represents a reallocation of existing resources rather than creation of new money. However, the relationship between government credit and the money supply becomes more complex when central banks enter the picture. Central banks are special government-affiliated institutions that manage monetary systems. Central banks can purchase government bonds. When they do, they create money to make the purchase. This process increases the money supply. It represents another form of credit creation, though one step removed from direct lending. Businesses also create credit among themselves. When a supplier delivers goods to a buyer with payment due later, credit has been extended. This trade credit represents trust between businesses. Trade credit operates through invoices and payment terms. The supplier sends an invoice stating that payment is due within a certain number of days. During those days, the buyer has effectively borrowed the value of the goods. The credit exists until payment is made. Collectively, all these different forms of credit creation add up to the total credit in an economy. The total expands when new credit is created faster than old credit is repaid. The total contracts when credit is repaid faster than new credit is created. The expansion and contraction of total credit has profound effects on economic activity. When credit expands, spending capacity increases. When spending capacity increases, economic activity tends to accelerate. When credit contracts, the opposite occurs. This dynamic creates a relationship between credit creation and economic cycles. The relationship is not simple or mechanical. Many factors influence both credit and economic activity, but the connection exists and matters. Understanding credit creation means recognizing that credit is not a fixed quantity. It grows and shrinks. It responds to conditions. It emerges from countless individual decisions made by many different actors. Each loan approved adds to total credit. Each bond issued adds to total credit. Each invoice extended adds to total credit. Each loan repaid subtracts from total credit. Each bond redeemed subtracts from total credit. Each invoice paid subtracts from total credit. The net result determines whether the credit supply is expanding or contracting at any given moment. This ebb and flow occurs continuously. It never stops. It adjusts constantly to changing circumstances and expectations. The adjustment process involves feedback loops. When credit is easy to obtain, borrowers take on more obligations. More obligations mean more spending. More spending tends to improve economic conditions. Improved conditions make credit seem safer. When credit seems safer, lenders extend it more freely. The loop can work in the opposite direction as well. When credit becomes harder to obtain, borrowers take on fewer obligations. Fewer obligations mean less spending. Less spending tends to weaken economic conditions. Weakened conditions make credit seem riskier. When credit seems riskier, lenders extend it less freely. These feedback loops create momentum. Expansion tends to breed more expansion. Contraction tends to breed more contraction. The momentum can carry the system far in one direction before reversing. But reversal does eventually occur. Expansion cannot continue indefinitely. At some point, constraints bind. Borrowers become overstretched. Lenders become cautious. The expansion slows and eventually reverses. Similarly, contraction cannot continue indefinitely. At some point, opportunities become too attractive to ignore. Balance sheets improve. Caution eases. The contraction slows and eventually reverses. The creation of credit, then, is not a steady process. It fluctuates. It responds to changing perceptions of risk and opportunity. It follows patterns that repeat but never identically. Those who create credit must navigate these patterns. They must judge when to extend and when to restrain. They must balance present opportunities against future uncertainties. The judgments are difficult because the future is always unclear. Credit extended today will be repaid or not repaid based on circumstances that do not yet exist. Those circumstances will be shaped partly by the credit decisions themselves. This creates a peculiar challenge. Credit providers must predict outcomes that their own actions will help determine. They must anticipate a future that they are simultaneously helping to create. The challenge has no perfect solution. Mistakes are inevitable. Sometimes too much credit is created. Sometimes too little is created. The system functions imperfectly, adjusting through trial and error. But despite imperfections, credit continues to be created. The mechanism persists because it serves essential functions. It enables economic activities that would otherwise be impossible or delayed. It allocates resources across time and space. It connects savers with borrowers, investors with entrepreneurs, present capacity with future potential. The creation of credit, in all its varied forms, represents a foundational process in modern economies. It generates the financial fuel that powers much economic activity. It operates through institutions, agreements, and trust. It fluctuates with changing conditions and expectations. It shapes what is possible and what is not. Having examined how credit comes into existence, the next question becomes how it operates day to day. What happens to credit once it has been created? How does it flow through the economy? What effects does it have on ordinary economic activities? Once credit has been created and extended, it begins to move through the economy. This movement follows patterns that repeat countless times each day. Consider a business that receives a loan from a bank. The loan appears as a deposit in the business's account. This deposit is money that can be spent. The business uses the money to purchase equipment. The payment transfers from the business's account to the equipment supplier's account. The credit has moved from the borrowing business to the supplying business. The equipment supplier now has funds that did not exist before the original loan was created. The supplier uses some of these funds to pay employees. The credit moves again, flowing into the employees' accounts. The employees use their wages to purchase various goods and services. Food, shelter, clothing, entertainment, saving. Each purchase transfers credit from one account to another. The credit continues circulating through the economy. At each step, the credit enables transactions. It permits exchanges that create value for both parties. The business gains equipment that increases productive capacity. The supplier gains revenue. The employees gain wages. The merchants gain customers. The circulation of credit is what makes it powerful. A single loan can facilitate many transactions as it moves through different hands. Each transaction creates economic activity. The cumulative effect amplifies the impact of the original credit creation. But the credit does not circulate forever. The borrowing business must eventually repay the loan. Repayment removes credit from circulation. The business generates revenue through its operations. Using the equipment purchased with borrowed funds, the business produces goods or services. Customers purchase these offerings. Revenue flows in. From this revenue, the business makes loan payments. These payments transfer funds back to the bank. When the loan is fully repaid, the credit that was created at the beginning is destroyed. This creation and destruction of credit happens continuously throughout the economy. New loans create credit. Loan repayments destroy credit. The net balance between creation and destruction determines whether total credit is growing or shrinking. In normal functioning conditions, credit grows slowly over time. This growth matches the overall growth of economic activity. As economies expand, they generally require more credit to facilitate additional transactions. The growth occurs through many small increments. A business secures a loan for expansion. A family finances a home. A student borrows for education. Each individual action adds slightly to the total. These individual additions might seem insignificant in isolation, but accumulated over millions of transactions, they shape the overall credit landscape. The functioning of credit day-to-day also involves constant evaluation and adjustment. Borrowers monitor their obligations. They ensure they can make required payments. They adjust their spending and saving based on their credit commitments. Lenders monitor their portfolios. They track which loans are performing as expected and which are showing signs of trouble. They adjust their lending standards based on observed outcomes. This monitoring creates information flows. Information about creditworthiness gets updated constantly. Past predictions are compared against actual results. Lessons are extracted and applied to future decisions. The information flows feed back into credit creation. When borrowers consistently make payments on time, their access to credit typically improves. When borrowers miss payments or default, their access to credit typically diminishes. These feedback mechanisms help maintain system stability. They reward reliable behavior with expanded opportunities. They constrain unreliable behavior with reduced opportunities. The incentives encourage people and organizations to honor their commitments. But the system is not perfectly self-regulating. Sometimes feedback works too slowly. Credit might expand beyond sustainable levels before problems become apparent. By the time issues emerge, damage may already be significant. Other times, feedback might be excessive. A few defaults might trigger panic that causes credit to contract too severely. The contraction itself can make conditions worse, creating a downward spiral. Managing these dynamics requires institutions that can moderate feedback effects. Central banks often play this role. They can supply credit when it becomes too scarce. They can restrict credit when it becomes too abundant. Their interventions aim to smooth out extremes. They try to prevent credit from expanding so rapidly that instability results. They try to prevent credit from contracting so severely that economic activity freezes. The day-to-day functioning of credit also involves intermediation. Financial institutions connect those who have surplus funds with those who need funds. Savers deposit money in banks. These deposits represent funds the savers do not immediately need. Banks pay interest to savers as compensation for the use of their money. Banks then lend these funds to borrowers. Borrowers pay interest to banks for access to the money. The interest paid by borrowers exceeds the interest paid to savers. The difference covers the bank's costs and provides profit. This intermediation serves an important function. It aggregates small amounts of surplus from many savers. It packages these aggregated funds into larger loans for borrowers. It transforms the maturity of funds, accepting short-term deposits and making long-term loans. Without intermediation, savers and borrowers would need to find each other directly. The search would be costly and time-consuming. Many potential matches would never occur. Credit would flow less efficiently. Banks reduce these search and matching costs. They provide a central location where savers can place funds and borrowers can seek funds. The centralization improves efficiency. The daily functioning of credit also involves price discovery. Interest rates adjust based on supply and demand. When many people want to borrow and few want to lend, interest rates tend to rise. Higher rates compensate lenders for parting with their funds and ration credit among competing borrowers. When few people want to borrow and many want to lend, interest rates tend to fall. Lower rates encourage borrowing and make lending less attractive. These price adjustments help balance supply and demand. They ensure credit flows to those who value it most highly. They allocate a scarce resource, the capacity to borrow across competing uses. The allocation is not always optimal. Interest rates reflect expectations about the future, and expectations can be wrong. Sometimes credit flows to activities that prove unproductive. Sometimes potentially valuable activities cannot secure credit. But in general, price signals guide credit toward productive uses. Businesses that generate strong returns can afford to pay higher interest rates. Their willingness to pay signals that credit employed in their activities creates value. Day-to-day credit operations also involve documentation and record keeping. Every credit arrangement generates paperwork or electronic records. Contracts specify terms and conditions. Payment schedules are established. Security interests are registered. This documentation serves multiple purposes. It clarifies obligations so both parties understand their commitments. It provides evidence if disputes arise. It creates the data that feeds into credit evaluation systems. The records accumulate over time. They form histories that influence future credit decisions. They create reputations that follow borrowers throughout their economic lives. Maintaining accurate records requires significant infrastructure. Databases must store information reliably. Systems must allow authorized parties to access relevant data. Privacy must be protected while enabling necessary information sharing. The infrastructure has developed over decades. It has evolved from paper ledgers to electronic systems. It has grown more sophisticated and interconnected. It now operates globally, linking credit markets across borders. This global connectivity means credit can flow internationally. A saver in one country can effectively lend to a borrower in another country. Financial institutions bridge the geographic gap. Currency exchange mechanisms handle the fact that different places use different money. International credit flows add complexity. They introduce additional risks related to currency fluctuations and political stability. They require coordination across different legal and regulatory systems. But they also increase efficiency. Credit can move from where it is abundant to where it is scarce. This movement helps balance global supply and demand. It supports economic development in capital-scarce regions. The daily functioning of credit, in all its mundane detail, represents the machinery that keeps economies operating. Loans are created and repaid. Interest accrues and is paid. Records are updated. Evaluations are made. Prices adjust. These routine processes rarely attract attention. They happen in the background, invisible to most people. But their cumulative effect is enormous. They channel resources across time and space. They enable activities that shape how people live and work. Understanding this daily functioning means recognizing credit as an active, dynamic system. It is not a static pool of resources, but a flowing stream. The stream changes course in response to conditions. It swells and recedes with economic tides. It carries value from sources to destinations, enabling transformation along the way. But credit does not operate in isolation. It connects with other economic systems and institutions. These connections create additional layers of complexity and influence. Credit exists within a larger ecosystem of economic institutions and processes. It interacts with these other elements in ways that shape outcomes for everyone. The most direct interaction is between credit and banking. As discussed earlier, banks are primary creators of credit. But the relationship goes deeper than creation alone. Banks transform the nature of money itself through their credit operations. When a person deposits funds in a bank, they receive a claim on the bank rather than holding actual currency. The claim can be transferred through checks or electronic payments. These claims function as money. They are used to make purchases, pay bills, and settle obligations. Most money in modern economies consists of these bank claims rather than physical currency. The relationship between banks and credit thus becomes a relationship between banks and the money supply. Credit creation by banks expands the money supply. Credit destruction through loan repayment contracts the money supply. This connection gives banks significant influence over economic conditions. Their collective lending decisions affect how much money exists. The amount of money affects spending capacity. Spending capacity influences economic activity. Because of this influence, banks operate under oversight. Regulatory authorities establish rules for how banks must conduct their business. These rules aim to ensure stability and protect depositors. One key set of rules concerns reserve. Banks must hold certain amounts of liquid assets relative to their obligations. These reserves provide a cushion against unexpected outflows or losses. Another set of rules concerns capital. Banks must maintain equity cushions that can absorb losses without threatening depositors. The capital requirements ensure banks have skin in the game when making credit decisions. A third set of rules concerns disclosure and reporting. Banks must provide information about their condition to regulators and to the public. Transparency allows others to assess risk and make informed decisions. These regulatory interactions shape how credit flows. Stricter regulations may constrain credit creation. Looser regulations may enable credit expansion. The regulatory stance affects economic outcomes. Credit also interacts with monetary policy. Central banks adjust interest rates and manage money supply to influence economic conditions. These adjustments work largely through their effect on credit. When central banks lower interest rates, borrowing becomes cheaper. Cheaper borrowing encourages credit expansion. Credit expansion boosts spending and economic activity. When central banks raise interest rates, borrowing becomes more expensive. More expensive borrowing discourages credit expansion. Reduced credit growth slows spending and economic activity. The mechanism operates through financial markets. Central bank actions affect the price at which banks can borrow from each other and from the central bank itself. These prices then influence the rates banks charge their customers. The transmission is not instantaneous or perfect. It takes time for central bank actions to filter through the system. The response varies depending on other conditions. Sometimes credit responds strongly to rate changes. Sometimes the response is muted. Central banks also interact with credit through direct interventions. During periods of stress, central banks may purchase assets from banks or other institutions. These purchases inject funds into the financial system. The added funds support credit availability when markets are not functioning normally. Credit also interacts with government fiscal policy. Governments borrow to finance their activities. This borrowing absorbs some of the available credit in the economy. When governments borrow heavily, less credit may be available for private borrowers. This crowding out can raise interest rates and reduce private sector activity. However, if government borrowing finances productive investments or occurs during periods of economic weakness, it might actually support credit expansion. Government spending can boost economic activity, which improves borrower creditworthiness and encourages lending. The relationship between government borrowing and private credit is thus complex. The effects depend on circumstances and on what governments do with borrowed funds. Credit interacts with labor markets as well. When credit expands, businesses invest in expansion. Expansion creates jobs. More people working means more income. More income supports additional borrowing and spending. When credit contracts, businesses reduce investment. Reduced investment leads to fewer jobs. Unemployment rises. Incomes fall. Borrowing and spending decline further. The interaction creates reinforcing cycles. Credit conditions affect employment. Employment affects income. Income affects creditworthiness and demand for credit. The cycle feeds back on itself. Credit also interacts with asset markets. Credit allows people to purchase assets such as real estate, stock, or bonds. When credit is readily available, asset purchases increase. Increased demand pushes asset prices higher. Higher asset prices create wealth effects. Those who own assets feel wealthier. They may spend more freely. They may also use their appreciated assets as collateral to borrow more. This creates another reinforcing cycle. Easy credit raises asset prices. Higher asset prices support more borrowing. More borrowing raises asset prices further. The cycle can reverse. If credit tightens, asset purchases decline. Declining demand pushes prices lower. Lower prices reduce wealth and collateral values. Reduced collateral constrains borrowing. The downward spiral can be sharp and painful. Asset price movements driven by credit dynamics can disconnect from underlying economic fundamentals. Prices may rise beyond what objective factors would justify. These elevated prices reflect speculation and borrowed money as much as genuine value. Eventually, reality reasserts itself. Asset prices adjust back toward fundamental values. The adjustment can happen gradually or suddenly. When it happens suddenly, it can strain the credit system severely. Credit interacts with trade and international commerce. Exporters often extend credit to foreign buyers. Letters of credit facilitate transactions across borders. Trade financing enables shipments to occur before payment is complete. Without credit supporting international trade, commerce would be much more limited. Buyers and sellers separated by geography and time zones would struggle to transact. The uncertainty and risk would inhibit exchange. Credit reduces these frictions. It provides assurance to exporters that they will be paid. It gives importers time to receive and sell goods before payment is due. It makes global trade practical and efficient. Credit also interacts with technological innovation. Developing new technologies requires investment before revenues materialize. Credit provides the resources for this early-stage investment. Entrepreneurs borrow to fund research and development. They use credit to build prototypes and scale production. The borrowed funds bridge the gap between conception and commercial success. Many innovations would never emerge without credit support. The time lag between investment and return is too long. The uncertainty is too great. Credit makes it possible to proceed despite these challenges. Credit interacts with education systems. Students borrow to finance their studies. This borrowing allows them to invest in skills before earning income from those skills. Educational credit alters life trajectories. It makes advanced training accessible to those without family wealth. It enables specialization and expertise development. It shapes labor markets by influencing what skills people acquire. But educational credit also creates long-term obligations. Students carry these debts for years or decades. The obligations affect their subsequent choices about work, housing, and family formation. Credit interacts with demographic patterns. Younger people typically borrow more than older people. They are building careers and acquiring assets. They have future income but current needs. Older people typically lend more than younger people. They have accumulated savings. They are preparing for or living in retirement. They have current resources but declining future income. Credit channels resources from older to younger generations. It enables younger people to acquire housing, education, and business capital. It provides older people with returns on their accumulated savings. Changes in demographic composition affect credit dynamics. An aging population means more lenders relative to borrowers. This can push interest rates lower. It can also mean more savings seeking investment opportunities. Credit interacts with social mobility. Access to credit can enable people from modest backgrounds to pursue opportunities. A small business loan can launch an entrepreneurial venture. An education loan can open career doors. A mortgage can facilitate asset accumulation. But credit can also entrench disadvantage. Those with poor credit histories face higher costs or exclusion. Those without collateral or creditworthy consignors struggle to access credit. The system can amplify existing inequality. The social implications of credit are thus mixed. Credit creates possibilities, but also creates risks. It can lift people up or weigh them down. The outcomes depend on many factors beyond the credit system itself. All these interactions mean credit does not operate independently. It is woven into the fabric of economic life. It touches nearly every other system and institution. Changes in credit conditions ripple through the entire economy. Understanding these interactions reveals why credit matters so much. It is not just a technical matter of loans and repayments. It is a central element of how economies function. It affects employment, prices, growth, innovation, and opportunity. The interconnections also explain why credit problems can be so destructive. When credit malfunctions, the damage spreads through all the systems it touches. Banks struggle. Asset prices fall. Employment drops. Trade contracts. The effects cascade and amplify. This brings the discussion to a critical topic. What happens when credit comes under stress? How does the system behave when conditions deteriorate? What mechanisms exist to maintain stability or restore it when lost? Credit systems can experience stress in various ways. The stress may build gradually or appear suddenly. It may affect specific sectors or spread broadly. But all forms of credit stress share certain characteristics. Stress typically begins with rising uncertainty about repayment. Borrowers who seemed reliable begin to appear less so. Economic conditions deteriorate. Incomes decline. Asset values fall. These changes make existing loans riskier. Some borrowers who were keeping up with payments can no longer do so. Defaults begin to increase. Rising defaults trigger responses from lenders. They become more cautious about extending new credit. They demand higher interest rates to compensate for increased risk. They may refuse credit to borrowers who would have qualified under earlier conditions. The tightening of credit standards reduces credit availability. Businesses find it harder to borrow for expansion or even for operations. Consumers find it harder to finance purchases. Economic activity slows. The slowdown worsens the underlying problems. With less spending, business revenues decline. Declining revenues make debt payments harder. More borrowers default. Lenders tighten standards further. This negative feedback loop can be severe. Once it begins, it tends to reinforce itself. Each step down makes the next step down more likely. In extreme cases, the stress can become a full-fledged credit crisis. Lending may nearly cease. Even creditworthy borrowers cannot access funds. The financial system appears to freeze. Credit crises typically involve panic. Lenders fear they will not be repaid. They rush to reduce their exposure. They call in loans, refuse renewals, and hoard liquidity. The panic can spread rapidly. Fear is contagious in financial markets. If one institution appears troubled, others worry they might be similarly affected. Trust evaporates. Without trust, credit cannot function. The system depends on belief that obligations will be honored. When that belief disappears, the system stops working. Historical examples show how destructive credit crises can be. Economic activity can decline sharply. Unemployment can soar. Businesses can fail in large numbers. The social costs can be immense. Because of these potential costs, societies have developed mechanisms to prevent or mitigate credit crises. These mechanisms operate at multiple levels. At the institutional level, banks maintain capital buffers. These buffers are designed to absorb losses without threatening the bank's viability. Regulators require minimum capital levels relative to risk exposure. Banks also maintain liquidity reserves. These reserves ensure they can meet withdrawal demands, even if some loans cannot be quickly converted to cash. Liquidity management is a core banking function. Deposit insurance provides another stabilizing mechanism. Governments guarantee bank deposits up to certain limits. This guarantee prevents panic withdrawals by reassuring depositors their funds are safe. Central banks serve as lenders of last resort. When credit markets seize up, central banks can provide liquidity to solvent institutions facing temporary funding problems. This backstop prevents liquidity crises from becoming solvency crises. Bankruptcy laws provide mechanisms for orderly resolution of unpayable debts. Rather than allowing chaotic defaults, these laws establish procedures for distributing losses and enabling fresh starts. Macroprudential regulation aims to reduce systemic risks. Rather than focusing only on individual institutions, these regulations consider risks to the system as a whole. They may limit certain activities that could destabilize credit markets. Despite these mechanisms, credit stress still occurs. The system is not perfectly stable. It goes through cycles of expansion and contraction. Some degree of instability appears inherent in credit-based economies. Understanding why requires recognizing certain fundamental tensions. Credit depends on predicting the future, but the future is inherently uncertain. Predictions will sometimes be wrong. When many predictions prove wrong simultaneously, widespread problems emerge. If lenders collectively misjudge risks during an expansion phase, they extend too much credit on too favorable terms. The excessive credit inflates asset prices and encourages speculation. Eventually, reality disappoints expectations. Asset prices stop rising or begin falling. Borrowers cannot generate the returns they anticipated. Defaults increase. The contraction begins. The cycle seems difficult to prevent entirely. During expansions, optimism builds. Risks appear manageable. Competition among lenders drives terms toward borrower-friendly extremes. The seeds of future problems are planted. During contractions, pessimism dominates. Risks appear overwhelming. Lenders become overly cautious. Credit-worthy projects cannot get funded. The economy underperforms relative to its potential. Policymakers try to moderate these swings. They tighten standards during expansions to prevent excess. They ease standards during contractions to support activity. The interventions help but do not eliminate cycles. Part of the challenge is timing. Recognizing problems before they become crises is difficult. During expansions, it is hard to distinguish sustainable growth from unsustainable excess. The difference only becomes clear in retrospect. Another challenge is political economy. Tightening credit during good times is unpopular. People resist restrictions on their borrowing capacity. Lenders resist limitations on their lending opportunities. The pressure to continue expansion is intense. Only after crises do societies accept stricter regulation. The memory of pain motivates reform. But as time passes and conditions improve, memories fade. Pressures build to relax restrictions once again. This creates a cycle in regulation itself. Rules tighten after crises. They gradually loosen during calm periods. By the time the next crisis arrives, protections may have eroded. Despite these challenges, modern credit systems are more stable than earlier versions. Crises are less frequent and less severe than in the past. The learning from previous failures has improved system design. Key improvements include better capitalization of banks. Banks today hold more equity relative to assets than in previous eras. This provides greater capacity to absorb losses. Another improvement is more sophisticated risk management. Banks use detailed models to assess and monitor credit risk. They diversify portfolios to avoid concentration. They stress test their positions against adverse scenarios. Regulatory oversight has also improved. Supervisors examine banks more thoroughly. They require detailed reporting. They intervene earlier when problems emerge. International coordination has strengthened. Credit markets are global, so problems can cross borders rapidly. Coordinated regulation helps prevent regulatory arbitrage and systemic risks. These improvements make the system more resilient, but they do not make it invulnerable. Credit stress will continue to occur. Failures will happen. The goal is to contain problems and prevent them from cascading into broader crises. When failures do occur, the response matters enormously. Authorities must balance multiple objectives. They want to prevent systemic collapse, but they also want to maintain market discipline. If every failure is prevented through bailouts, moral hazard emerges. Lenders and borrowers take excessive risks knowing authorities will rescue them. This sows seeds for future problems. But if failures are allowed to cascade unchecked, the economic damage can be catastrophic. Innocent parties suffer from decisions they did not make. The social costs exceed the private cost. Finding the right balance is perpetually difficult. Each situation presents unique features. The optimal response depends on specific circumstances. Judgment plays a large role. The existence of stress and occasional failure does not mean the credit system is fundamentally flawed. All systems that involve uncertainty and human judgment will sometimes err. What matters is whether the system can learn, adapt, and improve. Credit systems have shown this capacity. They have evolved significantly over time. They have become more sophisticated in assessing risk. They have developed better safeguards against catastrophic failure. The evolution continues. New technologies are changing how credit is evaluated and extended. New regulations are addressing newly recognized risks. New instruments are being created to distribute and manage credit risk. Through all this change, certain fundamentals remain. Credit depends on trust. Trust depends on performance. Performance depends on sound judgment about uncertain futures. When these elements align, credit supports economic prosperity. When they misalign, credit causes economic distress. The system's stability depends on maintaining alignment most of the time while having mechanisms to restore it when disruptions occur. Understanding stress and stability means recognizing that perfect stability is neither achievable nor necessarily desirable. Some instability creates learning opportunities. Some failures clear away unproductive uses of resources. The goal is not eliminating all stress, but managing it within acceptable bounds. This completes the core explanation of credit and its role in economies. The system has been examined from multiple angles. Its nature, creation, operation, interactions, and vulnerabilities have all been explored. But to ensure full understanding, the concepts deserve recapitulation. The following section will revisit the key ideas more slowly, using different language, allowing the material to settle more deeply. Let us return to the beginning and move through the ideas once more. This time with gentler pacing. This time allowing space between concepts. Credit is the ability to access value, now based on promises about the future. It exists because people and organizations face timing mismatches between when they need resources and when they have resources. Rather than waiting for perfect alignment, credit allows the future to fund the present. This time-bridging capacity transforms what is possible in an economy. Without credit, all exchanges would need to happen simultaneously. Both parties would need to deliver their parts at exactly the same moment. This requirement would dramatically slow economic activity. Projects would wait years for full funding. Opportunities would pass before anyone could act. Growth would be constrained by accumulated savings. Credit removes these constraints. It allows work to begin before complete funding exists. It permits purchases before complete payment is available. It enables investment before returns have materialized. The enablement happens through trust. One party trusts another party's future promise. The trust becomes formalized in an agreement. The agreement specifies terms and conditions. These agreements exist in vast numbers. Millions of credit arrangements are active at any moment. Together they form a network of promises spanning across time. Each promise links present action to future obligation. Today's loan creates tomorrow's repayment requirement. Tomorrow's repayment requirement shapes next month's financial reality. The links accumulate and interconnect. One person's borrowing becomes another person's income. That income supports additional borrowing. The web of relationships extends throughout the economy. Credit enters the economy through various channels. Banks create credit when they make loans. Governments create credit when they issue bonds. Businesses create credit when they extend payment terms to customers. The creation is not unlimited. Various constraints and incentives shape how much credit emerges. Regulatory requirements, competitive pressures, and risk assessments all play roles. Credit providers must balance expansion against stability. They want to extend credit to earn returns. But they must avoid extending so much credit that repayment becomes doubtful. The balance requires predicting who will repay and who will not. Predictions depend on information about past behavior, current circumstances, and future prospects. The information gets collected, analyzed, and scored. Entire industries exist to support credit evaluation. The evaluations guide decisions about whether to extend credit and on what terms. When credit is created, it begins circulating through the economy. The borrower spends the funds. The recipient of those funds has new purchasing power. They spend in turn. The credit moves from hand to hand. Each transfer enables a transaction. Each transaction creates value for those involved. The cumulative effect multiplies the impact of the original credit creation. But credit does not circulate forever. Borrowers must eventually repay their obligations. Repayment removes credit from circulation. The cycle of creation and destruction continues endlessly. New credit is created. Old credit is destroyed through repayment. The balance between the two determines whether total credit grows or shrinks. In normal times, credit grows gradually. The growth matches expanding economic activity. More transactions require more credit to facilitate them. But growth is not steady. Credit expands faster during some periods and slower during others. Sometimes it contracts. The fluctuations create economic cycles. Expansion phases see rising credit, spending, and activity. Contraction phases see falling credit, spending, and activity. The cycles result partly from feedback loops within the credit system. Easy credit encourages borrowing. Borrowing boosts activity. Stronger activity makes credit seem safer. Safer credit leads to easier terms. The loop reinforces expansion. Eventually, expansion reaches limits. Borrowers become overstretched. Lenders become cautious. Credit terms tighten. The cycle reverses. Contraction brings its own feedback loops. Tight credit reduces borrowing. Less borrowing slows activity. Slower activity makes credit seem riskier. Riskier credit leads to tighter terms. The loop reinforces contraction. These cycles cannot be completely eliminated. They result from fundamental features of credit. Credit depends on predicting uncertain futures. Predictions will sometimes be too optimistic and sometimes too pessimistic. But cycles can be moderated. Institutions exist to smooth out extremes. Central banks adjust interest rates and liquidity. Regulators establish standards for credit creation. Governments provide backstops during crises. These interventions help maintain stability. They prevent credit from expanding too rapidly or contracting too severely. They contain problems before they become catastrophic. Credit does not operate in isolation. It connects with every other part of the economy. It affects and is affected by employment, prices, trade, innovation, and more. The interconnections mean credit matters deeply. Changes in credit conditions ripple through the entire system. Credit expansion supports growth. Credit contraction impedes growth. The connections also mean credit problems spread. When credit malfunctions, damage extends beyond the financial sector. Businesses struggle. Workers lose jobs. Communities suffer. This is why credit stability is so important, and why societies invest in mechanisms to maintain it. Capital buffers protect against losses. Liquidity reserves ensure banks can meet withdrawals. Deposit insurance prevents panic. Lender of last resort facilities provide emergency funds. These mechanisms have improved over time. Each crisis teaches lessons. Each failure reveals weaknesses. The system evolves in response. Modern credit systems are more robust than historical versions. Crises are less frequent. When they do occur, responses are more effective. The worst outcomes are often avoided. But the system remains imperfect. It still experiences stress. Failures still happen. The challenge of predicting uncertain futures remains. What has changed is the understanding of these challenges and the development of tools to address them. The knowledge base grows with each generation. Credit shapes economies quietly but powerfully. It operates in the background of daily life. Most people interact with it without fully recognizing its presence. Yet it determines what gets built and what does not. It influences who can pursue opportunities and who cannot. It affects the pace of economic change. Understanding credit means understanding a fundamental mechanism of modern economic life. It means recognizing how promises about the future create possibilities in the present. It means seeing the invisible architecture that supports so much economic activity. The architecture has developed over centuries. It reflects accumulated learning about how to manage promises across time. It incorporates mechanisms to handle both success and failure. The system works because most promises are kept most of the time. Trust is generally justified. Borrowers generally repay. Lenders generally get their funds back with interest. This general reliability makes credit valuable. If promises were always broken, credit could not exist. If promises were never broken, credit would need no special mechanisms. Reality falls in between. Most promises are kept, but some are not. The system must function in this mixed reality. It does so through continuous evaluation and adjustment. Information flows constantly. Decisions are made and remade. Terms adjust to changing conditions. The adjustments aim to keep credit flowing productively, to support activities that generate value, to avoid activities that cannot sustain themselves. The aim is not always achieved. Mistakes happen. Credit sometimes flows to unproductive uses. Sometimes productive uses cannot access credit. But generally, over time, the system allocates credit toward valuable activities. The allocation is imperfect but functional. It serves economies better than likely alternatives. This is why credit persists despite its complexities and occasional failure. It serves essential functions. It enables activities that create prosperity. It connects savers with borrowers, present with future, possibility with reality. The quiet shaping of economies by credit continues every day. New loans are created. Old loans are repaid. Businesses expand or contract. Individuals pursue or defer opportunities. All influenced by the availability and cost of credit. All part of the vast network of promises that spans time and connects everyone in the economy. The network is invisible but consequential. It shapes outcomes without being directly observed. It operates through millions of individual decisions that collectively determine economic conditions. Understanding this network provides insight into how economies function. Why growth accelerates or slows. Why some periods feel prosperous while others feel constrained. Why opportunities expand and contract. The patterns repeat but never identically. Each cycle has unique features. Each period presents distinct challenges. But underlying dynamics remain constant. Credit expands when confidence is high and conditions are favorable. Credit contracts when fear dominates and conditions deteriorate. The swings create the rhythm of economic life. Within this rhythm, individuals and organizations make their plans. They borrow when they judge the timing right. They save when circumstances permit. They navigate the credit landscape as best they can. The landscape changes constantly. Terms tighten and ease. Opportunities open and close. The only constant is change itself. But within the chain, certain principles endure. Credit depends on trust. Trust depends on reliability. Reliability must be demonstrated over time. Those who prove reliable gain access. Those who prove unreliable lose access. The system rewards performance and punishes failure. This creates incentives for responsible behavior. Borrowers have reason to repay. Lenders have reason to evaluate carefully. The incentive support system stability. They do not guarantee stability. Human judgment is fallible. Circumstances change unexpectedly. Problems emerge despite best intentions. but the incentives generally point in constructive directions. They encourage outcomes that benefit both borrowers and lenders. They support economic activity that creates value. Through these mechanisms, credit has become woven into the fabric of economic life. It is no longer optional or peripheral. It is central to how modern economies operate. The centrality brings both benefits and vulnerabilities. Benefits include enhanced productivity, faster growth, and broader opportunity. Vulnerabilities include potential instability, inequality of access, and risk of cascading failures. Managing both benefits and vulnerabilities requires ongoing attention. Institutions must adapt to changing conditions. Regulations must evolve with the system. Learning must continue. The process never ends. Credit systems are always works in progress. They improve through experience but never reach perfection. This is perhaps as it should be. Perfect stability might require perfect foresight. Perfect foresight is impossible when dealing with an uncertain future. What is possible is adequate stability combined with capacity to recover from disruptions. Building resilience rather than preventing all failures. Learning from problems rather than expecting to eliminate them. Credit systems today embody this approach. They are more resilient than in the past, but not immune to stress. They can absorb significant shocks, but not every conceivable shock. The goal is maintaining function under most conditions while having mechanisms to restore function when it fails. This goal is achieved through the various elements discussed. Capital buffers, liquidity reserves, deposit insurance, regulation, and central bank backstops all contribute. Together, these elements create a framework for credit stability. The framework evolves, but the fundamental purpose remains constant. Enable credit to flow productively while containing risks. The balance is delicate and dynamic. It requires constant attention and periodic adjustment. But it is achievable most of the time. When achieved, the result is an economy where credit quietly shapes outcomes, where promises about the future create possibilities in the present, where the gap between having and needing can be bridged. This quiet shaping touches nearly everyone. Few fully understand it. Fewer still observe it directly. But all experience its effects. The home someone purchases, the education someone receives, the business someone starts, all typically involve credit. All reflect the underlying architecture of promises across time. Understanding this architecture provides perspective on economic life. It reveals why things work as they do. It shows how present and future connect. It illuminates the invisible system that shapes so much. The illumination does not require technical expertise. The core concepts are accessible to patient reflection. Credit is about time and trust, about promises and their fulfillment, about managing uncertainty as best as possible. These fundamental ideas, explored slowly and carefully, reveal how credit shapes entire economies. Not through dramatic interventions, but through quiet accumulation of effects. Not through single decisive moments, but through countless small decisions. Not through obvious mechanisms, but through invisible connections. The shaping is nonetheless real and profound. It determines much about economic outcomes. It influences the pace of progress. It affects the distribution of opportunity, all while remaining largely unseen. Operating in the background, functioning through institutions and instruments most people never directly observe. This is the nature of how credit shapes economies. Quietly but powerfully, invisibly but consequentially, through mechanisms that are simple in principle but complex in practice. The exploration of these mechanisms is now complete. The system has been examined from multiple angles. The key concepts have been presented and revisited. What remains is simply to rest with this understanding, to let the ideas settle, to recognize the system that shapes so much while being noticed so little. Credit and its quiet power over economic life. The invisible architecture of promises across time. The system that enables what would otherwise be impossible. This is how credit quietly shapes entire economies.